So I wonder if the mainstream media have been cracking into their stash of super discounted Baileys that I think Morrison's are running an offer on right now. A little bit too early, because if you look at the mainstream media headlines, it's a confusing picture right now. And in this video, my aim is to try and cut through this confusion and look at what the data is actually telling us so we can make an informed decision about what's going to happen with interest rates next year. And because this is specifically about property, even though we like talking about the wider economy, to also understand what's going to go on to the property market, because every time I look at a headline, we've got something completely different. All right, so let's cut through all of the BS. Let's cut through that mainstream media slightly tipple. Oh, sorry, I've got a dog barking upstairs. Headlines, and see what's really going on. So good evening or good afternoon into evening, everybody. If you're on the live, please give me a thumbs up and put something in the comments. If you are watching along on the replay, then please do play all out as if it was live and put in the comments anyway. And welcome to all of the new subscribers who are tuning in, maybe the first or second time on this live stream, where my aim is to cut through the mainstream media headlines to understand what's going on. And what a difference a week makes. This is the headline that I put up, I think it was last Wednesday. So 5 days ago, after our October GDP got released, where literally the media were going, oh my gosh, we're about to go into meltdown, red flags warning, GDP has gone down, we're going to go into recession, the world is over. Okay, that was last week's headlines. These are today's headlines. Okay, if I zoom in on these, we've got rebound in UK growth, opens up goals, gulf with Europe. UK business growth rebounds to 6-month high. Estate agents believe the housing market may soon emerge from the slump. Full of Christmas cheer, the mainstream media. Fantastic. So why is the media now going, look, Britain is amazing. We are rebounding and we're at a high. Okay, so let's try and understand, first of all, where these headlines come from for the bounce or apparent bounce in the UK economy, which all of a sudden, over the last 4 days, has completely changed. This is the United Kingdom UK Composite PMI. PMI stands for Purchase Managers Index. Effectively, this is a well-respected survey that goes out on a monthly basis, and basically supply chain managers respond with what's going on in their businesses. And we can see, right, if I zoom in on here, basically 50 is a benchmark. So if the response or the survey comes back and says 50, there's no change. If it's below 50, we're contracting or expecting to contract. And if it's above 50, we're expecting to expand. All right. Now, please be aware, this is not like GDP. This is not actual figures. This is based on a survey of a particular subset of people in a role. So we've hit actually stronger than anticipated. So we're above 50. So this is where the bounce in growth has come from. And when the headlines say, let me just go back to those headlines. All right. Particularly this one, UK business growth rebounds to 6-month high. If we look at it, technically, yes, we are on a 6-month high with the UK PMI. If we go from there, it's not exactly stellar or spectacular. Okay, it's not like we're all the way up here in the 60s like we were, but it also means we're not dipping down. So a few months ago, there was a preempt of the PMI where somebody said it's going to come in at sort of 46, 47, around there, and that was like a clear flashing indicator that we're going to be going into recession with that sort of obviousness. We've bounced back. We've gone above 50, which shows the expectation is an improvement. I'm also going to go through today some various other indexes, including the RICS. We're also seeing a change in sentiment. So what is definitely happening right now is a shift in sentiment. Now, this shift in sentiment, where is it coming from? Is it coming from the fact that the markets are calling for massive interest rate drops next year? Does that mean on a short-term basis that people think interest rate drops are a good thing because inflation is beaten? Interest rate drops mean the gravity is going to be removed from the economy and from the housing market, and therefore we're going to go back into growth and bounce back. So those are the questions that we want to answer today to see if that is the case or if it's a load of baloney. Okay, so this is what we're going to talk about. We're going to talk about, are we seeing a split economy right now? And when I say split economy, I want to look at the differences between services, between manufacturing and construction, but I also want to look at the differences between the consumer-facing side of the world and the business-facing side of the world, because I think we're seeing some big differences. And if we're into property, if we're trying to understand the property market, actually, just the GDP alone is not a brilliant reflection on what's going on on a day-to-day basis in a householder's home, if you like. What's going on with their affordability? What's going on with their budgets? And how does that affect the housing market? So I want to have a look at what's going on from a consumer point of view. We're going to look at in a bit more detail at the October stats that we looked at last week, but also Q3 stats for 2023 are out. I also want to look at the Rightmove HPI, just one little thing, so I know it's been out for a week or so now, and we're going to go and look at the RIC survey. And in the end, we're going to wrap it all up, and we're going to draw some conclusions. But I think personally, we can safely say that there is so many confusing pieces of data right now. There's so many confusing narratives, and I want to really sort of preempt this whole sort of data scrape on today's live stream and say, when we see all this confusion, when we see different headlines, confusing headlines, contradictory headlines and data, it means nobody really knows what's going on, and we haven't got a clear direction of travel. And my gut feeling is that's where we are right now. I've said for a few weeks now that it's tricky to understand what's actually going on, and we need a clear direction of travel, because we always talk about trends. Trends are the only thing that really matters. For us to look into the future, we need to understand what the trends are right now. And at the moment, it's all very chaotic, right? There's no clear trend anywhere, right? So with a lack of clear trend, everybody's going to be interpreting things in their own way. So even if we can't make a clear conclusion, maybe the conclusion is we've got to sit on our hands for a while and go into January, February, March 2024 before we see the direction of travel. Is the economy going to tip over the edge into recession? Is the property market going to capitulate? Are we actually going to see interest rates slash down and cushion everything? Right? These are things we need to understand and look at these trends. By the way, please feel free to ask questions as we go along. I'll go through the slides and I'll go through the data, and then I'll answer those questions at the end of the day. So let's start with have another look at the GDP report for October 2023. Okay, and we're going to start by looking at the contributions to GDP growth, which is split into services, production, and construction. Now we can see still we are in that seesaw. If I take off the individual elements and just look at the line, I said this last week, right? It looks like if we look at the back half of the line from here, we're now sort of vaguely trending down, but it's still non-directional as far as I'm concerned. If we look at services, now something to bear in mind is the UK economy is made up, I think it's 79% of UK GDP is based on services. So it's the biggest overall component between services, production, and construction. Okay, so in general, services has been fairly strong. Services has propped up the economy. And if we look at the last 12 months, the majority of the upsides or services has had a majority upside versus downside. If we compare that with production, for example, we can see it's completely different matter. Other than this spike in June, manufacturing and production has been significantly lower than services. So for me, there's a clear split between services and manufacturing, and actually construction as well. And if I go to construction, we see a similar picture. We've actually got a few large spikes here, but if you go from March 2023, we only have one significant spike up in construction. So if we draw a line March 23, predominantly negative on construction. We got predominantly negative on production other than June, whereas services are, again, definitely, I would still say it's not looking fantastic, but there are more ups than downs if we go from March 2023. Okay, so that's the first thing I want to highlight. And then when I highlight that, when we think about production, I'm just going to flip over to the iPad, because I want to look at 2023 as a whole in terms of quarters, and I also want to look at 2022 GDP so we can compare it. Now, this is a graph I pulled off the quarterly report for GDP. And yeah, what's very obvious first is we've got a GDP per head here, and we can see in the last quarter, we're negative minus 0.1 GDP per head. Quarter two in 2023 is we're 0.1 per head. So actually, we're flat as a GDP per capita in the last two quarters. We'll be interested to see what happens in Q4. What I'm more interested to talk about is this bit over here. So when we look at 2022, we can see that we have overall GDP growth of 9.7%. Now, this is effectively, this is nominal, okay? These are headline national account indicators for the UK, which is nominal growth. So this is actual amounts, not inflation adjusted. So when we look at most of the GDP figures, they're inflation adjusted. And something that I didn't actually realize until I dived into this, that GDP is not adjusted by CPI or RPI. It's adjusted by something called the GDP implied deflator. So nothing's never easy, is it? There's always massive complexity, just so most people like us can't have a look and work out what's actually going on. Now, whatever this deflator is, okay, when it's less than CPI. So this 5.2%, this implied deflator, when you work it out, and I've actually crunched the numbers, I got the raw data, and I did the compound effect of going up by this much every quarter. So 2% in quarter one, 2.2%, 1.4%, 2.2%. Did that sort of compound increase in nominal GDP and compared it to CPI, and it was a few percent below CPI. Which is interesting because that means if you adjust GDP growth by CPI, it's actually coming in at a negative. But when you adjust it by the GDP implied deflator, right, it comes in as a positive for 2022. So again, we're comparing different things. So a lot of people look at, property prices. When we're looking at real property prices, we're adjusting it by CPI. I believed that GDP is adjusted by CPI. So when we look at GDP, I thought it was a CPI adjusted, but it's not. It's an implied deflator, which is made up of a box of effectively factors depending on what we're looking at. And I just wonder, right, if this implied deflator is changing, right, the real GDP that we're being given based on lots of factors. And if that's masking where we actually are in terms of real, or sort of in nominal or, sort of CPI inflated GDP. So that's interesting. That's the first thing that I took away when I looked at this. The second thing I took away, and this is what I'm really trying to dive into, is how this is affecting households rather than sort of businesses. Because if you think about services, there are a lot of services which are business to business or export services. The UK is a hub of financial services. We export a lot of financial services across the world. When you go into the city and you look at financial services being pinged across all over the world, I'm not sure how relevant that is to understanding what's going on at a household level, because we need to understand what's going on at a household level if we are trying to understand what's going on with the property market. So this is why I want to have a look at this split between what's potentially going on a business-to-business level and a consumer level to understand the differences. So for household consumption, there was a fall of 0.4% in real household expenditure in quarter 3, 2023, following an increase of 0.5% in the previous quarter. Okay, so it's interesting to see that household consumption has actually fallen. And within household consumption, the largest contributions to the fall were from lower spending on miscellaneous goods and services, and that forms things like jewelry, it says clocks and watches, transport, in particular air transport and water transport, and spending on food and non-alcoholic drink. Net tourism also contributed negatively to growth in the last quarter. So that, to me, when you read that, sounds like people pulling back on non-essential spending, which implies there is an affordability issue with UK households. Now, if we switch back to the October read on GDP, I'm just going to sort of scroll down. Okay, we have here again. We have a graph here of services, but broken into. So if I take these two off, we've got index of services across the UK sector, and then we have all other services. Okay. And by the way, 100 is benchmarked to February 2020, so just before COVID. So we're above it. But then if we go to consumer-facing services, right, we are below it. So there's quite a difference between consumer-facing services and all other services. And actually, if we go from, where are we here? So the peak we hit was June 23. I say the peak. the peak since kind of, September 22, 96.4. Since then, we've been in decline. So actually, for the best part of 6 months now, we've seen consumer-facing services as a subsection of GDP declining. Again, that implies to me consumers are struggling, households are struggling, households are cutting back on things. Anecdotally, I was out in Chester with my boys on Friday, the weekend. Well, it's not the weekend before Christmas. The weekend before Christmas is this coming weekend, isn't it? But probably the last, full weekend after the schools have broken up, all of that sort of stuff. Friday, Christmas market, almost empty. Not almost empty. It's probably a bit of an over dramatic, but town felt dead. and Chester is usually buzzing. And in previous years, I go to Chester Market on a Friday night, Saturday night, and you literally can't move. You know, when you go into one of those sort of Christmas markets, and it's quite unpleasant because it's nighttime and you can't get away, you know, you can't move anywhere and get to any of the things or buy any food or sit down. It felt really dead. So it felt to me like there was definitely a cutting back. And I've got to be honest, we went to the pantomime in the theatre in Chester, and I ordered 2 orange juices for the boys, and it was £8. And I was like, £8 for 2 orange juices. No wonder people are cutting back if that is where we are right now. Now, I know that is completely anecdotal. Okay, so that's the first thing, to look at consumer spending. And I also want to look at production. Sorry, I'm on the wrong screen there. At production. Okay, so this is manufacturing and production. And something that really stands out to me there, if I take the rest of these off, is mining and quarrying, and how much that has declined over this year. And again, anecdotal story, but I was chatting to a business broker friend of mine about various things. And he said that he has got a business that he's selling at the moment that is in the mining and quarrying space. And the owner is operating at 50% of his normal capacity to where he'd be expecting right now, and has been through 2023, and is desperately scrabbling to find other markets to sell his aggregates into. And for me, that, if you look at leading indicators, that shows we are not building stuff, right? Construction has all but ground to a halt. And I think that's backed up if we scroll down even further, go to the construction sector. Let's get rid of everything but new work monthly index. And again, we can see since December 22, that has effectively been capitulating, right? And we're significantly down, 92.6 with a baseline of 2019, right? 8% below 2019 in terms of building. So there's no building going on. So there's no manufacturing going on. I say no, these are big claims. There's clearly stuff going down. But when you look at percentages, manufacturing is not making stuff. Construction is not doing stuff. Aggregates cannot sell their things. If you look at leading indicators, that surely filters into a position where we're not building houses, people are not spending stuff. The only thing in the manufacturing that's gone up is cars. And that's good. We've had such a supply constriction of cars over the last 18 months that now that's easing, and the price of cars is coming down. I think people are now, you know, going and buying cars or replacing the cars because prices are easing in the cars market and supply is increasing. So that's the only part of manufacturing that's going up. So for me, that is showing in terms of GDP right now that there is the split between what I would say is professional business-to-business services, which I believe is probably masking a lot of what's the underlying going on in our economy right now. And I'd imagine London being a centre for finance, I'd imagine quite a lot, and this is completely hypothesising right now, but a lot of people are going, I can't believe that we're not showing recession. We're not in a recession. You just look at the shop floor. Look at what's going on with, you know, with trade. Look what's going on in construction. The amount of people, you know, seemingly to be struggling to find work compared to a year ago. The feeling in the water is things have changed, but the economy carries on accordingly growing. But is this being masked by, you know, large-scale financial services sector exporting around the world and masking that, which is a very small subsection, you know, of our economy. And, you know, just to kind of emphasize that, I found this article, which is a little bit old now. It's last month, but talking about how over 70,000 construction firms on the financial brink as recession looms. Okay, and financial brink. So Q3 Begbie's Trainer Red Flag Alert report has highlighted serious concerns with regard to the outlook for the construction, real estate, and property services sector as critical financial distress. That's what it says at the bottom. Critical financial stress jumps 46% and 38% on Q2. So I don't know if you're like me, but there feels like conflicting narratives going on here in different subsectors of what's going on. And if we are interested in property, for me, building, affordability, all of these things are going to be directly, these are leading indicators into where we're going into the property market. I'm going to flash up next what I believe is probably the largest leading indicator of the property market that we can take into 2024. Before we do that, I'm going to ask for 30 seconds of your time to talk about how you can help me support this channel. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Cool. Please do hit that like button. Please do hit that subscribe button as we go into Christmas. It is Christmas after all. I can see some comments, by the way, from Mark talking about Red Sea and what's going on at the moment. I've got to be honest, I've not been watching the news today. I've been deep in project management mode, finishing off our Chester development. So I will brush up on that, Mark. Feel free to let me know what you think on what's going on at the moment in terms of current geopolitical affairs. So these things, and as I said for some time, by the way, I have no idea what is going on. I haven't looked at that, but because of the fragility in the system, external geopolitical affairs have the potential to create that black swan event that could tip things over the edge very quickly. I've said that for quite a long time. But let's look at the leading indicators. So this is the big one to me. This is the Rightmove HPI, House Price Index, which is the most recent one, came out, I believe, at the beginning of last week. And what we're looking at here is the 5-year asking price with their trends. 5-year asking price trend for house prices. Now, I've always said I'm not a massive fan of the Rightmove HPI because of the way it calculates it. It's not like Nationwide, it's not like Halifax, it's not like the ONS, which are hedonic regression models. The Rightmove effectively is taking a model based on the listing price of properties that go onto the platform and doesn't take into consideration things like price cuts, all that sort of stuff. Now, what we are seeing here, this, I would say now quite steep downward curve, for me, is a fair capitulation, or it appears to be a capitulation in trend of asking prices. If we were to draw, and I should have done a screenshot of this and done it on the iPad, but if we were to draw a line up here, okay, there's been a support line all the way up. And actually, I was talking about how we've basically had sideways movement. If you zoom out, don't go day to day, because people go, oh, asking prices going up. Oh, property prices are crashing. Asking prices are going up. Property prices are crashing. We don't need to look at it like that. We need to zoom out and look at the macro trends. The macro trend for about 18 months on asking prices has been pretty much flat with probably a double top. I talked about the double top, both in terms of Rightmove HPI and the actual ONS data. Last month, we saw, I would say, the trend line broken, and now I'd say we're seeing almost a capitulation in terms of what's going on with the asking prices. Now, probably going, this is in direct contrast to all the other headlines we're seeing about people talking about price, activity picking up, sentiment picking up in the property market. And I think we need to clarify here that activity picking up in the property market is not necessarily a good thing for the property market. Just because we're seeing more listings on, right, does not mean that means the property market's going to go up. If we're in a tough economy, a tough market, and we're seeing more forced sellers come in because of affordability issues, increase in supply is going to drive down prices depending on what the demand side is, okay? So we need to understand both supply and demand to see if this is a good thing or a bad thing. But for me, increase in supply, certainly in certain areas, is going to probably see a negative downward pricing or effect on house prices. Now, for me, what we're seeing here is sellers getting more realistic much more quickly, right? That does not imply to me that everybody suddenly thinks that, property prices are about to reverse, right? We can go up higher again. That says people are like, we need to sell because we're not sure that this is a great place to be anymore. So rather than hold on and wait for interest rates to come down, we're now seeing they're coming down. More buyers come to the market. Let's sell. Let's get now. Now's the opportunity to list our properties and get it sold, right? Every major property index I'm looking at, Halifax, Zoopla, and the Nationwide, all of them are saying we're going to see continued property price drops in 2024. Not massive ones. They're talking 2 to 3% over 2024, but they're all talking about drops over the next 12 months, kind of regardless of what goes on with the interest rates. What we can see here, interestingly, is we've seen a drop in average stock per agent. So yeah, that is not surprising because even though we've seen this increase in average stock per agent, we've seen a negative new flow supply when you look at the Zoopla HPI, which means, of course, things are still selling, right? A property market freezing and shutting down does not mean it just suddenly stops entirely. Even if you look at the credit crunch, we went from something like 1.2 million transactions to about 750, 800 in the very worst year of that, which is 2009. We're looking at sub a million this year. So we're kind of halfway in between normal and credit crunch. But we'll see how that goes into 2024, okay? What is obvious is it's taking longer to get buyers. So this trend is definitely on the uptick, and it's definitely increasing past mini budget. So if you think mini budget happened around here, and then the lag effect of that is January hit the longest, and then we saw confidence come back into the market, and since then it's been going back up. But we're seeing a clear trend of stock taking longer to shift. So just look at that, team, right? We are seeing a capitulation in asking prices. We are seeing it taking longer, the trend increasing of how long it takes to sell something. That is not great leading indicators for the housing market as we go into it, okay? So that's 2 consecutive months of coming up to 2% drop in average asking prices. I think that's interesting, and I think that's the best leading indicator of where we have. But to give some balance to that, I also want to talk about the RICS residential market survey for the last month, which came out again fairly recently. And the overview, let me just give you a highlight here of what the sentiment is on this report. Near-term sales expectations turn slightly positive for the first time this year. Okay, so I'll go through that data and what it means. And it says national house price declines appear to be slowing. Again, don't forget, this is a survey. This is based on respondents from different areas, so it's not cast iron. But let's go through some of these graphs. So we have national prices over the past 3 months. Let me just zoom in on this so it's a little bit more obvious on a box by box basis. Okay, so anything below the horizontal line means a net balance of decline. Okay, so it means more surveyors are saying we're seeing declines than increases. So you can see for quite a long time now we've been seeing national prices on the decline, but we've had a tick up. So it's still decline, but not as much. Okay, doesn't mean we're increasing. It means still declining, but not as much. When you look at this in the regional breakdown, okay, the teal diamonds are the 3-month average, and the sort of purple bar is the current month. So you can see across the board, I kind of exclude Northern Ireland. It's a little bit of a different market. You can see across the board pretty much that the decline is less. Okay, so it's slightly more positive, but still negative at the end of the day. Please, let's not forget this. It's not saying that things are going up. It's they're going down, but less. It's like the whole inflation thing, right? Inflation dropping doesn't mean inflation, if things are getting cheaper, it means they're going up at a lower rate. National inquiries. We can see a spike up in national inquiries in terms of they're still negative, but less negative, okay? So it's still negative. That's national inquiries. Here's an interesting one. National new vendor instructions over the past month. Again, spike up, but still negative. Now, something that I picked up when I looked at this is really clear actually, is we have a complete north-south divide in what's going on. So if you look at the south, which is pretty much here, so we've got London, southeast, East Anglia. Current month, we've had a sharp uptick versus the 3-month average. And I'm trying to follow through in my mind, why would that be? So the areas that have been hit the hardest in terms of house price declines, and by the way, this is instructions, this is not house prices, new vendor instructions. Effectively down south, we're seeing more people come to put their properties on the market. Now, the down south, or in the south, is clearly higher values and therefore higher sensitivity to interest rates. So does this feed through to people who've been sitting on their hands for a while, and now more people are coming to the end of their fixed rate, cheap fixed rate deals, and are now struggling, and therefore more people are putting their properties on the market? Or is there a perception that with interest rates coming down, there's more buyers, and so now's the time to list to get it sold in 2024? This is the problem with stats. We can interpret it and analyze it however we want. If we look at the north or Midlands up, right, we actually see the opposite. So we see the purple line generally larger in both directions. For Northwest, bizarrely, has got this really positive uptick on it. The purple line much bigger than the teal thing, which means Southwest, Yorkshire and Humber, North, West Midlands, Scotland. This month has been worse than previous months. So we're seeing a flip-flop between North and South. We can draw our own conclusions to that. With newly agreed sales in the past month, again, we've seen an uptick, but still negative. Again, don't forget, it's still negative. It's just less negative. And national price expectations, again, are ticking up quite a lot. So over the next 12 months, right, this teal line is now almost coming to zero, which means when it's at zero, it's balanced. So the same amount of RIC surveyors or valuers will think that over the next 12 months, property price will go up versus the amount that think it will go down. So there is an expectation that things are improving on the property market through RICs. Here we go. National sales expectations. So we're now positive in terms of the amount of properties that they believe are going to be sold. So now more surveyors do not believe we're going to see an increase in the amount of properties sold over the next 3 months and the next 12 months. My hypothesis has always been that if we are struggling in the economy and we see more sales, it's going to drive down prices in the short term. It's always been my hypothesis if we are in a environment where people are struggling with affordability. Okay. The only other one I want to talk about, actually, because I think it's fairly interesting, is the lettings, national tenant bond for lettings. It looks like we've peaked on the insanely hot lettings market we've had, but it's still positive. It's just going up at a lower rate. Okay, so tenant demand and landlord instructions, we can still see landlord instructions are negative and have been for a significant amount of time. You go back to 2017, we had a little spike after COVID, right, with people, there's some pent up demand, but take out that COVID spike and, a little flurry of new landlord instructions when basically market was booming. We had very cheap debt, and I think some people were taking, opportunity from that. Maybe not the greatest thing in retrospect. We see this continued negative decline of landlords, right? This is such an opportunity, team. The amount of landlords that are still exiting the market is creating such an opportunity in that space. It's a really distressed space right now, particularly, buy to let. I don't want to go into that today. I want to know that today, all I want to talk about is what we think is going on with the data. Okay, so that's the data I've got to share with you today. It's confusing, it's conflicting. I'm not gonna deny that. So what do we draw from this in terms of our interest rate prediction? Well, a lot of people are comparing where we are to the States and going, the States have now changed their narrative. The Fed has changed their narrative to interest rate cuts. And people are going, look, we are generally 6 months behind the States, right? So the Fed's talking about cuts, so that means we're going to get cuts next year as well. This is the latest chart of predictions based on the committee on the Fed. Current rate is this bar here, and we're going into 2024 where we're expecting to come down, and then over the next few years, come down again. So we've got one person down the bottom there that thinks in excess of 1%. Most people sitting in the middle, about a 0.5, 0.75% cut in 2024 for the Fed. But something we need to understand is that USA is in a totally different economic position to us as the UK. So we cannot just go, let's use our forward-looking crystal ball and go, America is going to happen here. We can't do that, right? Let's have a look at the American economy. If we have a look at our GDP as the UK, okay, so far, that's us, 0.3, 0.2, 0 over the last 3 quarters, quarter on quarter for the previous 3 quarters. This is the States, 0.6, 0.5, 1.2. The United States economy is in a strong position. And not only that, they have a strong economy, but they have inflation pretty much well and truly under control. I know it's still above their target, but their inflation is completely different to our inflation. And that's for various macroeconomic reasons. I don't really want to go into things like Brexit, supply, like we're now a net importer of utilities, of electricity and gas versus where we were not so long ago, which is previously a net exporter, completely different positions. So we cannot look at the American position and go, we're going to directly put it across to us. Despite that, the city is predicting a 1% fall within 12 months. And well, I say predicting now, this is a few days old. This was after the GDP shock 0.3% drop came in, and the market went, oh, we're going to lose 1% next year. Right, that's their prediction. For a while now, we've seen Bank of England versus the city. Bank of England saying we're not going anywhere. City going, we're calling your bluff. You're going down quickly. The latest comment from a member of the MPC, Ben Broadbent, and I actually want to sort of highlight this here. Okay, where he says the headline is Bank of England needs to see clearer decline in wage growth before rate cuts. Ben Broadbent, a policymaker in the bank, said there is still a lot of uncertainty around how the UK economy is performing. And this, for me, is the crunch point. This is the narrative. It's almost impossible to understand where we are right now. Every week we get a data set that says something different. And in general, when we have that flux, that chaos, that uncertainty, it's very, very difficult to understand what the trends are and then have a forward-looking projection. So where do I think we are? I don't think we're going to see interest rate falls very quickly next year, right? I think we are underlying in a worse place than the headlines and things like the PMI are suggesting. Services, GDP suggesting. I think inflation is more sticky than CPI is suggesting. I think a lot of these things, we're seeing the glossy side of it in the mainstream media headline. I personally feel that we're on the brink with all of these people coming off cheap fixed rate debt still into 2024. I feel interest rates will stay high. I feel the bank wants to get us into recession to get rid of this inflation. I think that's what they're trying to do, but they're balancing it to not completely grind us in, but they want a mini or a mild recession in 2024 to reset things. I think that's what they are aiming for. And so therefore, my thoughts are we're not going to see interest rates come down as quick as the markets. But I'm very happy to be proven wrong on this. So this time next year, before we get to Christmas 2024, please somebody find this video and say, Rob, you were completely wrong. By the way, I would just like to stress that I benefit from interest rates coming down with a significant amount of debt in a property business. All of it is covered, but obviously profit margins are higher when the debt comes down because I've got a fair amount of commercial-based variable debt right now. So I benefit from interest rates falling. I don't think they are going to fall that quickly into 2024 if they do at all. Okay, so that's my point of view. If that was useful to go through some of that data, give me a thumbs up. I can see somebody's put a thumbs down. Why have you put a thumbs down? Is there anything I've said that's really controversial there? Apologies if I have. And I'm going to go through some of the questions. Not an awful lot today because I don't have a huge amount of time. We've got some talk about the Red Sea, so I'm going to go up on what's going on in the Red Sea. Robin says, let's put this on. 5-year mortgage swap rates at 3.5%. Are they? Have they gone down to 3.5%? That's a huge drop, isn't it? I think Bank of England has done too much. I think you're correct. UK on brink of recession. I think Bank of England will have to go in reverse with the rates. Interesting. So, Robin, different to what I said there, in that I think they're trying to force us in to recession. Maybe when they do that, right? When we do, then they will ratchet it down. But if the recession, it depends on the data sets and what quantifies as recession, right? And this is what I mean. I feel that there are subsets of let's just find. I just want to show you this. If I go back to the overall, and this is where I feel. Let's go to this one. Sorry, Robin, I'm going to have to take your comment off so people can see. If we go to this graph, we can see the components of GDP based on services, which is the light blue, production dark blue, construction green. Now, bearing in mind that services makes up 0.8% of GDP. When you look at last month, right, services minus 0.15%, production 0.1, and construction minus 0.03. So production and construction have made up pretty much the same percentage-wise of the GDP drop of 0.3%, yet services takes up 80% of the actual. Again, let's, the month before, we got a fairly 80 split. But for me, that means that there's something weird going on in services. So yes, services come down, but surely, if it's coming down, it would make a bigger percentage to GDP decline than that. So I feel that because we're so service orientated, And a lot of the services are not consumer-facing services because we are a big exporter of financial services. And we've probably got a big concentration of very high-value financial services. I was looking into this week. I didn't realize that we are one of the global leaders of fintech, for example. You look at fintech, and if you look at GDP contribution to fintech exporting around the world, there's going to be huge amounts of turnover that is based on things like fintech companies on a global scale, which are going to be skewing these figures compared to quarrying and mining and construction of new houses, right? It's going to skew it massively. So I can't help but feel our GDP figures are skewed by that. I might be completely off on it, but that's my thoughts. Okay. Brody says, I think we're in agreement, Brody. I know that people don't like to hear this, but I strongly doubt rates will be cut in 24. And here, look, why would rates? No, we're in this. We talked about it for quite a long time. Rock and a hard place. We have sticky inflation. It's going up for householders. Affordability is still struggling for households. Yes, we've got some, now real-time wage increase for the first time in 18 months. People's affordability have been eroded. Look at the price of stuff out there. Almost tenner for 2 orange juices on a Friday night. These are not great. It's not like everybody's out there splashing their cash, right? So there is inherently sticky systemic inflation in our economy, which I think, again, is being masked and skewed by how we calculate our basket of goods for inflation. So with inflation high and wage growth high, it's difficult for the bank to cut interest rates, and we've got this past the parcel inflation, all that sort of stuff, and now we're wobbling on the on the economy. Logic would dictate if we start tanking recession, you're going to have to put interest rates down. But if you put interest rates down and systemic inflation is not solved, then it's just going to come back and it's going to be even worse in the medium term. Which is why I think a lot of the market is going interest rates cut in the short term, but then it's coming back in the medium term. That's something to bear in mind there. Anyway, let's continue. Robin, Anecdotal Evidence. A boomer landlord friend of mine put 1-bed flat in London on the market, sold within a week for 25k over asking. Interestingly, 3 first-time buyers, competitive bidding. I'm going to put that on, Robin. So this is interesting because I've bought, or I'm in the process of buying, 2 things this year. One we bought, we agreed in January. The other we agreed a few months ago, and we're just getting to the point of completion. And I have to be honest, we've got aggressively good deals on both of these things. Now, I obviously know where to look because I do this as a living, as a professional property investor. Know how to negotiate, know where to find the motivation and the price points. And I think we've got markets within markets, as always, in property. So there's some markets, especially first-time buyer markets, where and we see an interesting place where, because rents have gone up so much, interestingly, it's still cheaper to go out and get mortgages on higher interest rates, but spread it for 25 to 40 plus years to get those monthly payments down. And it's actually, from a cash flow point of view, costing you less than going and renting the same thing. Certainly when we are kind of, up that north-south divide, so north of the north-south divide, it's certainly cheaper to still go and buy than it is to rent, because rents are off the scale. So if they have the ability to buy, bank of mum and dad, find some money from somewhere, spread your mortgage over 40 years. Actually, it's not, a 40-year mortgage at 5% interest or 3.5% or 4% or whatever it is, whatever people are getting these days, it's probably not going to be costing you any more than a 2.5-3% mortgage was a year and a half ago. It's over 20, 25 years. It's not costing you any more. In the short term, in the long term, it's going to cost you hundreds of thousands of pounds more. And here is the ticking time bomb we've got going on that I'll be talking about in 30 years' time with long grey sort of wisdom beard when I'm still running the YouTube channel, going, the whole of the UK pension funds have gone to crap because everybody's on these long mortgages and spent all the money on interest. But we'll come to that for at a different time. So yeah, I think there's going to be markets within markets at all times. Reed Green says, be good to know more about your experience of buy-to-let, i.e. what's the best investment, house, etc. areas. This is a simple one, Reed Green. My experience is 15 years in single lets, houses of multiple occupation, then buying blocks of flats, then buying mixed use and commercial, then doing larger commercial conversions and new build developments. So I've done that for 15 years. Right now, it's almost like you've segued into me putting a report up for you to download, or other people. My experience now, or where I think the opportunity is right now, I strongly believe this. Okay, and it's buying something called property unicorn. So for me, a property unicorn is something where you can force significant appreciation. And for me, it's got to be 6 figures or more of value appreciation that you can force. So not passive gains, not buying something, sitting on it, waiting for the market to bring it up like it's been doing for the last 20 odd years. Forced appreciation of 6 figures or more, and is going to cash flow for you $3,000 a month or more. So to do that, you need to look at higher density units. So mixed use buildings with flats and commercial, or small blocks of flats under a freehold, or things like apart hotels. So you can buy, little old guest houses, B&Bs, turn them into high-end apart hotels. So you can force appreciation, recycle funds, get a huge amount of cash flow, but importantly, getting a large return on capital. Now, I've said all that really quickly. Okay, so if you want to know more about that and how to, and by the way, right now is a fantastic, amazing opportunity to do that, because the exodus of buy-to-let landlords and the exodus of people from the commercial space and the massive depression in the commercial real estate values that we've seen over the last 18 months, because it's linked to interest rates. And as interest rates go up, commercial valuations go down, because yield is inversely proportional to value, right? So there's huge opportunity for the next 2 years. If you want to know how to do that, download the white paper. I know I flick this up every time. robstuartglobal.com/white-paper. It's going to tell you about how I do it, where I think the future of buy-to-let is, which is in what I call the property unicorn space, and how anybody can get involved in buying property unicorns. Okay, so please go and download that. It's completely free. PDF. It'll take you about 30 to 40 minutes to read through that. Hope that makes sense and is useful for you. And it's so important. I'm going to give you a double thumbs up, which is going to put some, hopefully some, it's not going to do it now. There we go. It's going to do some funky things. That's what Apple's decided to do. Neely, Rob, the UK normally follows the USA Fed. However, not this time just yet. The bank is still giving savers a fixed saving rate for the 1 year. So I don't think there's going to be any big change for a while. Still a lot of employment, so maybe pressure's lower. Yeah, agreed, Neely. Mayowa, how you doing? So you believe end of 2024 now for interest rates? I've always said that I think interest rates will probably start coming down Q3 23 to Q4 23. It's impossible to give an exact, because I've said this a few times now. We need to see the direction that everything settles in. We have no settled direction right now. If you're a trader and you see market volatility, like complete chaos in the market, there's sayings that some people can make a lot of money in chaos, but if there's no trend, no patterns, you sit on your hands. And I feel now is the time to sit on your hands for the next month or two, probably into February, just to see what trends are going. And then when we see a definitive trend, right, we can then start to have a better idea of where things are going to go over the sort of medium-term time frame. There we go. Dan, sorry, I accidentally knocked the thumb down button. Thank you, Dan. I appreciate the honesty. I'm a sensitive flower, so it's funny, right? There's a cycle. So just right. I will announce this right now. It's not a formal announcement, but for years I've had a sort of desire to create a community in the property space. It's something I just haven't had the time to do as a project, because I've been so busy doing other things, mainly growing a group of scaffolding businesses and growing my own portfolio of properties for the last few years. It's been a fantastic time to be buying. 2024 Q1, right, start of Christmas, I'm going to be launching the Property Unicorn Club. And there we go. I've said it now, so the name is out. So no more polls about what we're going to... It's not going to be like Property Investors Academy, all these dry things. Property education has been so... It's like the property market, right? Property education market has not changed in 15, 20 years. It changes in glacial pace and it's outdated, right? So I have this vision to create a community in the property space, the property investment space. It's going to be called the Property Unicorn Club. And it's very much going to be about high performance, how to get the best out of yourself, and how to be relevant in the current market. So no outdated courses saying things that were working in 2009 post credit crunch or whatever. It's going to be regular live updates on how to invest in property. Guys, super low price point, super high value, and it's something I'm going to be growing in 2024. One of the things that I love talking about is how the brain plays tricks on us, because actually all of these hacks tactics doesn't matter, right? High performance and getting the most out of yourself is the key differentiator between those who are successful in whatever they do and those who are not. And one of the things we have is this binary, and it's all down. But sorry, I'm totally going off tangent here. It's all down to the brain and how we've got this limbic part of our brain, this old reptilian part of our brain, and then it's covered in the new intelligent bit, which is called our neocortex. And this bit is a right little bugger, right? This is the chimp. I don't know if anybody's read Chimp Paradox. This is the chimp that's in there, and it tries to get out all the time. And something that it hates, or it gets very threatened very easily. So you could see, I don't know how many you've got, like, sort of 26 thumbs up, 1 thumbs down, and immediately the chimp goes, wait a minute, what's this threat? And it comes out and it starts, either making it go into fight, flight, or paralysis mode. And this happens in our lives all the time, by the way, and we're bombarded by all these sensory inputs. We read a news headline and it does it, or somebody puts a comment on a Facebook post and it does it. So it's really important to be able to sort of build these strategies and these mechanisms about how to sort of control and harness that chimp. Sorry, I've gone totally off piece there. So Dan, appreciate that. Matt, you feel Bank of England will drop rates due to negative growth whilst Fed will drop into a booming economy? Yeah, so I'm going to put that to the broadcast. I think that's a really interesting point. And this is what I mean. So I think we are at completely different stages. I think the Fed will be dropping more quickly because they have tamed inflation, right? If their inflation was high, sticky, systemic, they wouldn't be looking at dropping. But they've got strong growth in their economy, and they've now got inflation that seems to be under control. So they don't need to keep them dialed up anymore. They can look at easing. For us in the UK, it'd be very. The only way I feel we're seeing interest rate cuts in the next 6 to 9 months is if we're going into deep recession and they have to cushion it. I think that's way more likely than just having a soft landing and going back into growth in 2024. Nobody's predicting growth in 2024. Even the most bullish of property commentators are not thinking we're going to reverse into growth. 2025, we looked in depth at the Savills report that looked at decline 24 and then 25 we're going to return to growth. I thought that was pretty. The model that assumed was best case scenario. I just feel there's something that is going to come out left field in 2024 and could catch the economy by surprise. And because everything is so delicate, and another thing to talk about the property market right now is it's so difficult to understand the stats when we're in such low volume of data. The data is so small, the data set, because we've been in this freeze, not a credit crunch, but a market freeze for the last few months. The transaction's so low, mortgage lending is so low. Everything is skewed, and so everything's on a knife edge. So it's very difficult to understand where we actually are. The only caveat to that is because I do primarily talk to property investors, although I know a lot of people gain value just about the property market and the economy as a whole on this, and I'm into buying and selling business as well. But from a property point of view, the only caveat is all of this doesn't matter if you're investing properly, right? If you know what you're doing and you're buying the right things, and you can force the value appreciation. Like if you could force 25 to 50% value appreciation on a property, I don't care if it's going to go down 5-10% over the next 2 years. I really don't care. If I can generate a 50 to 100% return on my capital, regardless of what the market's doing, I don't care. All it's doing is presenting opportunities to be able to make it easier to buy things at a price where we can force the value appreciation like that, which is completely different, by the way, by going down London and trying to buy a 2-bed flat in a block competing against first-time buyers. Completely different games. Absolutely different games. So I don't know if that answers your question, but I do believe UK and US are in totally different trajectories right now. We'll see. There we go. Team, I've got to go because it's almost 10 to 6 and it is the week running up to Christmas. I'm going to be doing one live stream this week, which will be Wednesday evening to go through the inflation print. There was a prediction of it dropping to 4.2 I've seen. So before I go, everybody type in what you believe CPI print will be on Wednesday. Do you believe it's going to be up? Do you believe it's going to be down? Do you believe it's going to be level? Do do you even care? Is one of the things I'll say. I think it's going to be interesting to see what happens, because that could give a little insight as to what's going to be going on into Q1 2024. If you do think it's going up or down, put a figure in, put a projection. Where do you think? I don't think it's going to be 4.2, but I was wrong last time by a good couple of decimal places. So put something in now before we head off. While you do that, I will answer Stafford's. Stafford's, we've had no real growth for over a decade. We have stagnate. We are total stagnation, right? Total stagnation. Alexandrina, sorry. I will answer your question. Need-free mortgage, end of Feb 2024. 2 years, 3 years, fixed, or 6 months of tracker would be a better option, please. Thank you. I assume, Alexandrina, this is for your personal property. I'm very reluctant to give out advice on personal properties. I think we've got to see what rates there are in Feb 2024. I don't know how long beforehand. I would be waiting definitely until after Christmas and seeing what's on the market. Gut feeling, look, it's so difficult, isn't it? In my investment portfolio, I hedge. So I have some on fixed, I have some on trackers. As the interest rates were coming down in COVID, I benefited on some, lost on others. As they've gone up, again, those ones that are fixed, I've benefited on those and lost on the ones that have gone up. So I like to hedge, because rather than go all in on one, I like to have some stability. What would I be doing right now? So I am taking a portfolio mortgage out on the properties we bought this year in a different company. And I am doing that on a variable rate tracker. Now, the reason I'm doing that is because that is commercial lending, and it is interest rate linked, so base rate linked. So I feel for me on that, we have more risk, also more upside potential for it coming down than going up. So there's not a huge amount of difference between the variable rate and the fixed rate right now. If there's a massive difference, let's say, for example, I was being offered a fix at 6% and a variable rate of 3 above base, right? So what would that be? 8.25. Then I'd go fixed. For sure, I'd go fixed if it was for 2 years. Would I go fixed for 5 years? Probably not. So I can't answer the question unless I see what you're being offered, is the honest answer to that. Sorry if that's a bit of a cop-out. Oh, we're going down. So the general consensus is down by 0.5%, down a smidge. Brody is up. Nearly last big drop was Chris Energy. That's sorted now. There we go. I think the general consensus is down on Wednesday. I reckon it might just be a slight curveball and go up a little smidge. I don't know. I'm just going left field on that one. All right, team. Have a great couple of days. I'll see you on Wednesday. Have a great one. Enjoy your evening. It's almost Christmas. Don't get too festive just yet.